There's been a surge in borrowing by sub-Saharan African countries, taking to the international debt market. Roy Daniels, he's the head of trading at RMB. He joins us to give us more insight on Africa's rush towards Eurobonds. But we are not alone here. We're also joined by Bonnie Tunya, who joins us from the east of the continent, and Esther joins us from Nigeria. Welcome to everybody. Maybe let me start the conversation off here just to give a base. We have seen a rush of African countries going into the international debt markets. It was supported by ultra-low interest rates, but this is set to change, right?
Well, the rush isn't going to change. That's going to continue for now. I've just returned from Angola. There's talk of a 1.5 billion roadshow down there as well to raise more funds. So it's fine when rates are low. US talking about, the Fed talking about rate hikes. I think we can see that's going to happen pretty soon. Though you're going to see a slight uptick in some of those Eurobond yields. The past month, we've seen Eurobond yields stabilize, slightly lower, backed by the oil price being above 60. Oil price below 60, we're seeing those yields ticking up again. Low volumes, low liquidity. I think a little bit nervous. I think there might have been, are we guilty of over-issuance across Africa? I have my own views on that one, and I feel we probably have, and it's going to get expensive for these countries.
I just wanted to touch on corporate South Africa in terms of Eurobonds. I mean, I know African Bank were pretty heavily involved in Switzerland issuing such bonds. Companies like Mediclinic, Steinhoff, and even more companies growing into Europe, the likes of Spar and Foschini. I mean, how are they perceived in terms of risk compared to, say, the countries?
I think the Eurobond issuances out of South Africa are very different to the Eurobond issuances we're seeing out of the rest of Africa. What we're going to see is that as the central bank goes after more Eurobonds there, it'll open the door for companies inside the rest of Africa, and I don't want to make it sound like we're not part of Africa, but excluding South Africa, you'll see more of those corporate bonds going to market. South African corporate bonds come with a lot better backing. It comes backed by investment graded country. It comes backed by a solid fiscus, a solid economy. The other economies in Africa, not as well set, I think, as South Africa. I think we are seeing some struggles in those countries. We've seen those currencies a lot weaker. That's adding to the little bit of instability. So a bit more concern about what's happening north of our borders. I think the South African Eurobond issuances are fine. I think those yields might tick up a little bit as well. I think you're going to see, if anybody went to market now, I think you'll see people holding back. You'll see investors from offshore holding back because they want that yield curve to tick up a little bit on the back of the decision by the US. So you'll see this little delay, I think, now. I don't think it's, but if you'd gone to market a little bit sooner, 6 months ago, you might have got in. I think at this point, you might find some guys holding back and less likely to buy the corporate Eurobond issuances.
Roy, Bonnie here from Nairobi. We've seen a lot of excitement on account of Eurobonds for the African space, both from the lenders and the African economies. And they've really thrown caution to the wind in regards to debt ceilings. Could we be, in effect, mortgaging our economies?
Bonnie, I think we are running into dangerous space now. It's fine, you know, raising these Eurobonds, getting the funds from the Eurobonds and using them into infrastructure. If we're using those Eurobond issuances by the sovereign to build and sort of service infrastructure, I think it's great. I think if the vision of the Eurobond is for the future, and how's it going to help us boost growth for the future, I think it's fantastic. I think we're looking at the Eurobond issuances. We got a huge sort of hurdle in 2020 of when 2020, 2022, when these bonds mature and they need to be repaid. You know, we've got to be, by now we should have had infrastructure in place that allows us to build up a bit of a drip fund that we can start dropping cash into, that we can then build a sort of capital base that we can repay these bonds. If not, we're going to be in the situation that we've often seen for Kenya, where they've had to reissue another Eurobond to pay back a Eurobond. Now, are we borrowing from Peter to pay Paul? I think that's the space we're in. So when we've got a Eurobond maturity of $1 billion, we go and we issue 1.5, and we pay back the 1, and we keep the 500. So to be used for infrastructure, used as a capital account balancer. We can't keep using debt to balance the capital account. You can't keep borrowing money to balance the mortgage on your house. At some point, that house has to be paid for. Now, I'm not saying that we shouldn't be issuing Eurobond. I think we can't overburden the local market by continuously issuing local currency bonds. Because then we're borrowing from our own market all the time, we're pushing the debt up locally. It's good to be using these Eurobond issuances. They're coming slightly cheaper, but we need to look at, that we get the right value out of them, and we do build a sustainable platform that we can repay these bonds.
Roy, hold that thought. I want to bring Esther in quickly before we head on to a very short break, and we'll be right back. Esther, do you want to weigh in here at this point?
Yes, I wanted to ask Roy a question. Roy, Esther here from West Africa. Now, Nigeria is not a newcomer to the Eurobond market. We've had two Eurobond issuances so far, one in 2011 and one in 2013. Now, the one in 2013 was very successful, was oversubscribed 4 times the size of the offer. And right there at that time, there was a lot of global financial markets were in a bit of a roll back then. But despite that, there was strong confidence on the part of investors. But now Nigeria finds itself in a rather difficult position where, as you know, the lower oil prices impacting very heavily on government revenues. You talked about the fact that there shouldn't be so much pressure on domestic debt. Nigeria has found herself in that position. We've borrowed very heavily on the domestic front, and everybody now says it's time to lean more on the international market. Given the size of the country, given its strong economic fundamentals, would Nigeria still hold that appeal that it had a few years ago when it went to the market, or do you think investors will be looking at the country differently now, especially now that they know that there is significant pressure on revenues?
I think when we look back in 2013 and sort of 2011 so that period, the Eurobond issuances, remember Zambia went for 750 million to the market, total bids received $15 billion. So that told you at that point there was a lot of money still around looking for yield, and it was happy to go into emerging markets. So I think that when we look at Nigeria now, I think President Buhari's delay in naming the cabinet only now due in September, it's left this bit of uncertainty around Nigeria. So until that, and those are easy things to fix. When it's all in place, the government's in place, they've come up with their policy statements, they've come up with what their plans are for the future, I think that's the time then for Nigeria to go to the Eurobond market. And once again, I think if they go, it will be oversubscribed. People like Nigeria. If you have an Africa portfolio, you have to have Nigeria in it.
You're still with us on Open Exchange, and we are continuing the discussion around Eurobonds. We're just going to wrap up this discussion, Roy, but you have long been sounding the alarm. The IMF have now said we have to be very careful when African countries decide to go to those debt markets. The World Bank has also done the same thing. But before you answer that, maybe let's just get a closing comment here from Byron.
Well, it's pretty similar. Just a quick question, and I know every African country is different, but in general, especially amongst the bigger countries, the debt to GDP, from the readings I've done, it's quite low compared to the developed world, and that will indicate sort of demand for these bonds. So what is the debt to GDP amongst the bigger countries within Africa? Do you know?
I think if we look at a country like Kenya, the debt to GDP ratio sits at about 47%. Had Kenya not got a debt write-off in 2003, it would sit north of 100%. So, it's nice to have these low debt to GDP ratios, and it's because of the debt write-offs we had in sort of the late 90s and early 2000s. I don't think that is likely to happen again. And it also comes down to then the serviceability of the debt. So African countries, where should they aim at? Can they get to like a 75% like Germany has? I don't think that's the levels that they should be aspiring to. They should be aspiring to levels below 50% and using that for infrastructure development.
Roy, please confirm my fears. A lot of the issuances were negotiated when the currency was fairly strong at 87. We're now at 102 for the Kenyan case. What does this mean about our repayment?
So it's going to be more expensive in Kenyan shilling terms, largely. And you're saying, if you look at it from 84 to 104, so you're looking at about a 20% more expensive in Kenyan terms, in Kenyan shilling terms. The funds would have been converted into shillings. It's now going to cost more shillings to repay that debt. Means I don't know what they're going to do. They're going to raise extra Kenyan shilling cash somewhere out of the local economy.
Roy, finally from me, I was going to ask a similar question that Bonnie asked about the currency here. I suppose you know about the current volatility here, the Naira against the US dollar, what it is at the official market, a strong belief by investors or analysts that it should be devalued, especially if you look at the gap between what we have at the official market and the parallel market. How much of that do you see playing into, if Nigeria does decide to go to the Eurobond market, how do you see that playing out?
So the currency rate won't have anything to do with the demand of the Eurobond. The Eurobond will still be issued, there still will be demand. The investors offshore like the Eurobonds because it removes the foreign exchange component for them. The question is, when you bring that Eurobond onshore, when do you then convert to local currency? My view is they should issue the Eurobond if they want to, hold on to the dollars, wait until the currency devalues, probably set at 220, 230, and then look to convert.
Roy, thank you so much for coming in. A big thank you to Roy Daniels. He's the head of Africa trading at RMB.